No data, but no room for error either. Can the Fed make the right call without the numbers? This is Macro Matters, and we're talking about the Feds. With key economic data frozen by the government shutdown, the Fed is heading into its next decision, flying blind. Another quarter-point cut looks all but locked in, as officials rely on private data to fill the gap. Last month, recession fears outweighed inflation worries, and Fed Chair Powell says that balance still holds. But if the data blackout drags on, deeper divisions could surface by December. So what happens when the Fed is forced to set policy in the dark? Let's ask Gregory Daco, Chief Economist at EY-Parthenon. So Gregory, private data suggests that inflation rose in September. How reliable are these indicators, and will this be reflected in next week's delayed CPI number?
Well, I think what we are going to see when the CPI data come out is essentially a sign that inflation is indeed continuing to rise. There are ongoing pressures from tariffs that are filtering through to goods prices and gradually as well to services prices. Because many services that we consume are essentially dependent on equipment or goods in order to be provided. So we're going to see a further acceleration in inflation. And some of the private sector data has also shown that there is underlying softness when it comes to the labor market, which indicates that the Fed is likely to lean towards more easing in the coming months.
Meanwhile, Trump's immigration crackdown could cut the workforce by 7 million by 2028. Could this push firms out of the no hire, no fire stance?
Yeah, I think we are in an environment that is highly unusual with this significant supply shock to the labor market. We've seen a significant reduction in net migration estimates from various sources. And when we calculate that into the labor market trends, we see that we're going to be in an environment where the break-even job rate growth is going to be a lower number, likely below 50,000 jobs per month. I think there is really a risk that we see the downside risk to the labor market continue to pressure the economy, and that could entail slower consumer spending activity and in turn slower economic activity. So it's a key risk to watch.
So overall, though GDP revisions and spending are showing strength for the US economy, what's keeping it afloat, and when should it give pause for the Fed's thinking?
That's the key puzzle right now in the economy. We continue to see GDP growth being relatively resilient, but the labor market has slowed. Some have pointed to the fact that this could be a sign that productivity growth is accelerating. There is certainly some indication that productivity growth is accelerating as we talk to a lot of businesses that are talking about efficiency gains. But I think that the likely trajectory for GDP growth is going to be to the downside, given the labor market's softness. We're likely to see slower income growth, which in turn feeds into slower consumer spending activity and slower GDP growth over the course of 2026.
Well, Powell did hint that the Fed may end its balance sheet runoff soon, and stocks often rally during QT. Could the end actually be less bullish than investors hope?
Well, I think generally speaking, the Fed has wanted to work in an environment of ample reserves, and Fed Chair Powell signaled at the latest NABE annual meeting that we were approaching that level. So the Fed is likely to announce over the next couple of months an end to its quantitative tightening process and essentially allow the balance sheet to grow in line with the currency in circulation over the rest of 2026.
Next up, and Goldman Sachs warning that credit growth risks are mounting amid recent fraud scandals. How will the Fed weigh these credit market jitters?
Well, I think generally speaking, credit is very important for the US economy. What we're seeing is that there are some pockets of fragility in household balance sheets, especially for lower income individuals and for the younger generation. When you look at auto loans, when you look at credit card delinquencies, you are starting to see some pockets of fragilities. It's not broad-based, but it's certainly something to pay close attention to because credit is really the grease that wheels help grease the wheels of the economy.
So finally, Gregory, a short list for the next Fed chair is said to be coming in December. With the hawkish Fed lineup rotating next year, which candidate would markets prefer?
I don't know which candidates the markets would prefer, but I think generally speaking, there is going to be a shift towards potentially a more dovish leadership at the Fed over the course of the next year. If we see an environment where we have a candidate like Governor Waller taking the chairmanship of the FOMC, that's likely to put a bit more of a dovish leadership in control of the Fed. But at the same time, the regional Fed presidents is likely to show a more hawkish rotation amongst voting members next year. So there's going to be more dispersion and more polarization amongst FOMC voters.
That was Gregory Daco from EY-Parthenon. Don't forget, you can watch more videos on Reuters.com.